talking about here in this video, the most important fair value gap that you can use when trading. Now, the most important fair value gaps that you can trade and use, in my opinion, are going to be the ones that either form after sweeping the high or the ones that form above the high that was broken. So for example, you'll sometimes get a fair value gap like that after sweeping or breaking through a high. And in this case, we're talking about a bullish example. So if we're expecting, bullishness to continue, then the fair value gap that was formed above the high or the one that was formed after the high was swept, and if price comes back to revisit it, you should expect that fair value gap to continue higher, right? So as you can see, this is a really good example, because this is an example that we talked about just a little bit ago when I was showing you the visual presentation here. You can see that price action broke above the Asia high right here. So it came and it formed this fair value gap here. So you can see after this candle close and after this candle close, we formed a fair value gap right here, right above the Asia high. So we formed another fair value gap up here. Now you can see how price starts respecting it, right? Even this candle, it respected this upper fair value gap. Because remember, if we're looking at fair value gaps, we're looking at that last fair value gap, right? That formed right above the high. So this is the last one that formed above this high. It respected it, respected it, respected it. 8 o'clock opens, and I mean, you can see what happens here. So we're expecting all this low resistance liquidity from the previous day to get hit, and it gets hit.